people say like, how did you get the 72 streams? Well, it started with one, right? And then it went to two, and then it went to three. It's not something you have to think like, oh, I could never get there. I mean, hey, if you can figure out one new one, now you've added to that stream, and it's all possible.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Bryan Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 261. My guest today could be called prolific in many different ways. First of all, he's an accomplished film composer in Los Angeles who has created music for many popular movies and TV shows. He's also prolific in his real estate investing in that he's created 72 streams of income, and he enjoys his share of the cash flow from over 25,000 rental units consisting of single-family, apartments, self-storage, mobile home parks, retail shopping centers, and notes. Bryan Miller is an investor, developer, and film composer. In his 16 years of real estate investing experience, he's flipped over 20 homes in multiple markets, raised over $7 million in private money, and he's currently building 46 single-family homes and 58 rental units in Los Angeles. And today, we're going to find out how he's managed to accomplish all this. Bryan, welcome to the show.
Thank you, Bryan. It's nice to be here. Thank you for inviting me on.
Well, it's always exciting to have someone in the film industry on our show. I'd love to hear just how kind of what you're doing now in the film industry and how you're able to incorporate real estate and why you even began incorporating real estate in the first place.
Well, I'll tell you, one of the things is I started my journey as a solopreneur, starting out scoring movies, and actually it didn't start scoring movies. It started doing fetching coffee and doing whatever I could to try to get my feet into the Los Angeles market here. I knew I loved music. I knew most people spent 40 hours a week making a living. So I figured, why not do something you love for those 40 hours a week? And so, what I'm doing now is I'm working on, movie trailers, which is your background. I do music for those, music for advertising, music for feature films, scoring films, licensing music, doing audio post-production. So have our hands, and that's an interesting journey in and of itself, how it started out with basically taking a job, do a job, complete the job, go look for a new job, and then figuring out how can I scale that business, right? And that was really important. And I applied those same skills in the real estate world, right? So in the beginning, it was just like you get your job and you're done, and then you're back to being unemployed and you go look for the next job. But along the way, I figured out, hey, all my clients that are coming to me for music, they also need audio post at that same point in the process. So if we could offer those services of sound design or audio cleanup and mixing, then we could provide more than one service. And that same client, it actually made it easier for them because they had to make one call. When they got everything back, it was all ready and synced. There was no music guy blaming the post guys or vice versa. We were responsible for the whole package. So that's worked out really well. So in that journey, you're on your own, right? So I knew any kind of retirement plan that I had or life that I wanted to live after I stopped working crazy hours of the film business, that I had to figure out a way to provide for myself, right? There's no pension except for the one you fund yourself. There's no 401k except for the one you fund yourself. We don't have a union. So that's just the reality, is you're on your own. So I started learning actually from my mother-in-law, and she had basically 4 rental properties. She was a single mom. She paid those off. And, when I married her daughter, she'd be like, I'm going to go to Egypt this month. And then the next month, I'm going to go to Paris. And I was like, wow, how is she doing that? And just that, 4 simple properties kicking off like, $4,000 a month gross in rents, just that same thing. And so if you're listening to the show, if you can just think, if I can just get 4 rental properties, pay them off, that's enough to radically change your financial future. Now, it may not happen immediately, but it's going to happen over the course of time. And so just know that, and in the beginning, when it's like, this is a lot of work for, $75 of positive cash flow, just realize you're playing a long game, and that, eventually you're going to be really happy you got involved and got started.
So before we really dig into your getting into real estate, I want to hear about the sexy side of doing music and sound for film and TV and trailers. And then I want to just real briefly the non-sexy side of that as well.
There you go. Well, the sexy side is the photos from the Grammys or the Emmys, and people go, "Ooh, wow!" That's the sexy side. The reality
hanging is, out with all the artists and the stars.
There you go. Not so much. I mostly live my life in isolation. They're on the screen, but they've gotten paid and moved on by the time I'm involved with the project usually. So I don't find it. I mean, it's glamorous in the sense that everybody's like, "Oh, wow, that's really cool." For me, I love music. So I love writing music. I love composing music. The fact that people will pay me to do that is a beautiful thing. That to me is the kind of the super fun part, is to do something that you're passionate about, make a living at that. In the beginning, squeak by a living at that, and then make a moderate living at it, and then make a pretty good living, and then like make an extraordinary living at it, right? Again, it's the long game, right? If I had looked at what I was making the first year in this business, I would have smartly given up, right? So, and you don't realize in the beginning of any journey, whether this is the beginning of your investing journey or your business journey, that in those beginning years, that eventually you'll make in a month what you used to make in a year, right? It won't happen immediately, but eventually if you keep after it, if you keep getting smarter, keep improving your skills, figuring out how to create more service, right? How do you serve more people? That's what we did with the audio post. We were serving people in a greater capacity, and so therefore that helped our business grow. And then eventually you can make, in a week what you used to make in a year, right? So those things will continue to ramp up and to the point where you can actually make in a day what you used to make in a year. Now, the asterisk on that story is what I used to make in a year was a really small sum. It started very humbly. And people say, "How'd you get started?" I was like, one humble opportunity after another. They didn't look very glamorous in the beginning. I actually had an opportunity to work on some Disney shows, and I was the low man on the totem pole. And so I'd work basically Wednesday, I'd put in like a 10-hour day. And then Thursday noon, I would work, and then work all day Thursday, late into the night, all the way through the night. At like 10 and 9 o'clock in the morning, we'd leave and go to a session, do a double session. So that would be like till noon, and then 1 to 4, 1 to 5, and then you'd be done. And you didn't sleep in that whole time. And it was just what you had to do to get the job. The show must go on, because the music was, getting written at the very last minute, and then getting recorded on the Friday. And then the next week you'd start the process again.
A lot of people don't realize that the music in movies and TV is one of the last elements that gets finished before it's released.
Exactly. So as budgets get eaten up and as time gets eaten up, it's just that's the reality of what you're left with at the end, is you have to deal with those parameters usually.
Bryan, going back to your mother-in-law, you saw that she had these 4 properties, and just the cash flow from those allowed her to take these amazing vacations. What light bulb went off in your head that got you started?
I'll talk just a little bit more about that, because I love that model. That's part of what I love about a cash flow model versus the kind of the typical financial advice of the 4% drawdown rule, right? So my dad grew up in the Depression, has that kind of mentality of like, at any point in time, the world could change. And so you don't know what you're going to need. So you better hang on to it all. Right. And so that 4% rule, like most people, I mean, the average person.
What is a 4% drawdown rule? I'm not sure.
So basically, financial advisors say, hey, if you can get $1 million or $2 million, if you spend 4% of that a year, right, then you can live on that until you die, basically. Because if you're growing at kind of hopefully 5% or 6%, there's enough growth there as you take away the 4%, or it's kind of like, but basically, let's just say you reach the American dream of having $1 million in your retirement account. So then your goal is to spend down like that 40 grand a year, that 4% of $1 million, right? You get 40 grand a year, which depends where you live, but in LA, that's not really killing it, right? As a lifestyle. But
you won't be able to live in Studio City for 40 grand a year.
Exactly. And dog food gets old like more than once a week. So you just, in planning for that, you have to think about like, what kind of lifestyle do I want? But basically, the model is you get $1 million nest egg, and then you start whittling it down, and your hope is that the month before you die, you get to zero, right? So you're basically trying to hang on to a little bit of cash. So you're just spending, then, and then it's like, I'm broke and now I die, right? So for me, there's just so little freedom in that, right? I would want to hang on to as much as possible. You don't know what kind of bills you're going to have in the future, what kind of health costs you're going to have. So there's just not a lot of freedom in that spend down rule, at least for me and my personality, right? Where if I can get 20 or 30 grand a month in positive cash flow, like I can spend that. And the good thing is next month I get 20 or 30K in positive cash flow, right? And that nest egg of whatever that is, it doesn't go away. So it allows you to give something to your kids, give something to charity. You're basically, it's sort of like, I guess on simple terms, it's like either building that golden goose, right? And living off the eggs, or basically slicing 4% off the goose every year and just hoping there's a little bit of goose left for the last meal.
Yeah, that's a good way of putting that. So when you realized that was kind of the model that your dad was following, and you saw your mother-in-law's model, what was your first step into investing in real estate?
So I bought a house in Los Angeles in 1999, which ended up being a really smart move. More money than I ever thought I would ever spend on a house. And now it looks super cheap. So there's a lot of debate about should you buy a house, should not buy a house. Depends on your market, depends on your situation. I think people that give absolutes on either of those end of the spectrum, it's a more complex decision. But I would say in my case, it worked out phenomenally well because that house is appreciated like 4x over the course of time that I've owned it in 20 years. So, just how many assets do you know that you'd buy or stock that in 20 years is worth 4x? I mean, some maybe, but that's a good investment by itself. It also ended up being the catalyst of helping me get involved with real estate because we were able to get a HELOC starting in 2004, which is a home equity line of credit, pull out money from that, basically borrow at 4 or 5, 6%, whatever it was at the time, to buy our first rental property in 2004. So just a simple single family house, $121,000, rented for about $1,000 a month. Not quite the 1% rule, but it worked. Nice area of town. So we chose a better area of town for a little less cash flow, which in retrospect ended up being a really smart move. And as people get more sophisticated, they realize that sometimes being in the nicer area with what looks on paper to be a little less cash flow ends up being the superior decision long term, because you're going to get more appreciation, you're going to get more rent growth, and you're going to have less turnover, more demand for it, so fewer vacancies. So a lot of good things. So we bought that, and I remember, being fairly freaked out about it. I'd wanted to do it for a while and finally pulled the trigger. And we found a really nice renter. She moved in, and we got the deposit. Everything seemed okay. A month later, I get a check for $1,000. I'm like, oh, that's all there is to this, really? Why was I so freaked out about this, right? It's like, okay, this works. So we bought another one in 2006. And then probably the smartest thing we did was not buy anything, because, I went to lots of seminars, people were trying to sell like, hey, if you get a zero interest rate loan that's going to reset in 2 years, you can get $50 a month positive cash flow. And I was like, this just doesn't seem like a winner, right? These were out of state. And, the other thing about that time is there'd be a development of 200 properties and there were going to be 200 renters, right? So the reality of that is then you have basically an identical house. You have competition of 200 other houses, right? And so it's like, if somebody's willing to take $950, somebody will take $925, and then they'll take $900, right? So just trying to get it rented. So it's really tough when you have so much competition, right, in your immediate area. And so I just fortunately stayed away from those.
I was living in Los Angeles. We moved in 2005, but 2003 to 2005 period, you could literally see the bubble forming.
You could.
In all around LA.
Right.
So yeah, I was in the same boat as you. It's like, this won't end well.
Right. Exactly. I remember at the time we bought our house, and then just a couple of years later, the neighbor's house went up for sale. It's a similar house. It was like $100,000 more than my house. I was like, wow, this real estate thing is working pretty well. So it worked well on the way up, and in the long run, it works well too. People that didn't panic in the downturn are still happy today. It's the people that either got panicked and chose to walk away just because they said, "Oh, my house is going to be worth less," or just got nervous during those times, or couldn't afford their payment during those times that got hurt. But that really led to the big opportunity. So I was looking for I was looking for rental property in Phoenix. I liked that market, but everything was like crazy priced. When I was looking kind of during the run up, people were saying like, "Hey, we're losing $800 a month, but I'm sure our property is going to double in value, in 6 months." And so they were taking on these big negative cash flowing deals, hoping for the appreciation play. Well, eventually the fat lady sang and the party was over, right? So once that happened, I actually found a Craigslist ad because I was just looking for property. And I found this condo for $50,000 in Craigslist. And now I was quite sure it was a scam, but I was like, okay, I'll call and see. And so I talked to the realtor and said, "Hey, I'm interested. Is this for real? Are you legit?" And he goes, "Well, the one in the ad there sold, but," he goes, "I have hundreds of these. So just come on down and I'll show you hundreds of them." So I was like, wow, $50,000 for a condo. That sounds pretty good to me.
Well, even compared to LA prices during the Great Recession, that's like cheap. That's
exactly
really cheap.
Super cheap. And the reality is like a property like that would have sold for around $200,000 a few years earlier, right? So we were able to go in then in that market and just start buying as much property as we could finance and acquire during that period of time from 2009 to 2012. And basically everything we put an offer on, we got during that three-year period of time. And we bought a lot of things right off the MLS. So anybody else could have done that. It's just part of what I would share as the insight is, I call it running into a burning building. Everybody else was running out screaming and wailing and like, "Don't go in there. It's dangerous in there. Like, you're going to get burned." And I knew statistically, like when I was buying a house for $33 a square foot, and I knew it was going to cost $70 to $100 to rebuild it, right? That eventually you're going to come back to what it costs to build a house, because you can't build any more houses until you get back to that point, and eventually they're going to need to build houses. So I figured it would come back. I didn't figure how quickly it would come back, but I figured that it would come back. So just by buying that, but I'll give you kind of metrics on that, on just the beautiful thing about single family and leverage. So one of the houses we bought, it had at its peak was $400,000, right? We bought it for $100,000, like 25 cents on the dollar. So it's $100,000 with 20% down. You put $200,000 on it, right? Or sorry, excuse me, $20,000 down, right? So you have a $20,000 investment. The house appreciates from $100,000. Now it's worth $300,000, right? So it's gone up $200,000 in value, but on a $20,000 investment. So that's like a 10x, right? Or 1,000% returns. So those are returns that will be beautiful. And so I would share, even though your listeners don't have an opportunity to do that today, there will be other opportunities. So part of that is like being ready to strike. It's kind of the Warren Buffett thing. Be greedy when other people are fearful, and be fearful when other people are greedy, right? Just when the whole herd was buying houses in 2006 and early 2007, that didn't make any sense, like stay away from that herd, because people would come to parties. "Oh, I just bought 2 houses. I bought 3 houses." And they had no real estate experience. They didn't have deep pockets, right? And so to stay away from that, but then when everybody else was running away, to be a bit contrarian and go in hard, even though it was risky, I mean, there are people in my family, some people thought like, "Hey, that's, it's a lot of money," or like, "Real estate's dangerous. Are you sure you want to do this?" Right? But you take out, they're all risks, but sometimes you take calculated risks. So I attempted to take a calculated risk, and it worked out super well for us.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. How many of those did you pick up in Phoenix then?
We picked up 19 in Phoenix during that time. And some of the limitations were, capital, getting financing. For a while, you could finance 10. Then you could finance 4. They changed the rules. Then they moved it back to 10. Then we found out you could actually do 10 in your name and 10 in your spouse's name. Some of those we paid cash for, but financing was definitely a constraint. Knowing what I know now, I could have done a few things differently and leveraged and partnered with other people to help keep acquiring properties during that time. But we bought as many as we could figure out how to do with the bank at the time.
That was a great time for you to be acquiring properties.
It really was.
Do you still have those or have you sold them off?
No, I still have those. So when I go to real estate meetups, I talk to the old guys, the guys 70, 80 years old. The number one thing I hear from them is, I wish I had never sold a single property, right? And I just kept hearing that over and over. And so it's like, pay attention to this, right? So I have done like a cash out refinance where we were able to pull basically all our money and then some out, which is another beautiful thing about real estate, right? Because, it took a chunk of cash for us to acquire those. We had to put 20% down on all those houses or pay cash for some of those, depending, because I bought a house without a kitchen, right? Because the guy getting foreclosed took the kitchen with it. Well, you can't finance that property, so you have to pay cash for it. But we were able to be in that position because the music business was doing really well during those years. So then just basically taking capital from the music business, redeploying it over into the real estate business and building that into a business.
So we have now accounted for 20 of your 71 passive income properties. What was next after that? So the Phoenix thing was a great bonanza, a great run for you.
It really was.
Yeah.
It really was.
It's hard to top that. So what did you do next?
Sure. Well, I realized then at that point, I'm potentially buying myself a job, right? Because, we were still early on trying to develop systems and this one at this address, is the property tax paid on it? And, oh, wait, how's the insurance on this, right? So it becomes, there's a lot of moving parts, especially early on as you develop kind of your systems and get it down. And I realized, hey, this is more work, and I'm already busy. So part of what I did then is at that point when I did the cash out refinance was pulled out like $1 million or whatever. And then I started looking for syndication deals and partnering with flippers. So on a flipper, I would lend them money and then we would kind of split the profits on doing a flip project. And so we do that. And then the other thing is I got turned on to the syndication model where basically a group of investors acquire a larger asset like a shopping center, a mobile home parks, or a whole series of self-storage units. And that's a beautiful business too, right? Because especially if you are kind of I call myself, the real estate is sort of the side hustle, right? So I'm busy. I love my career. I love writing music. I don't really want to give that up, but I also love real estate and what it's doing, right? So in that, I'm looking for ways, how do I leverage not only my dollars, but my time, right? So by partnering with a professional operator who knows what he's doing, who's very active in that, it's a pool of people who put their resources together to buy an asset that I couldn't afford to buy on my own or shouldn't buy on my own, right? Because let's just say I could afford to put $4 million and buy a strip mall, right? Well, then you have a lot of eggs in one basket, right? And so there's a danger to that, right? So it's much better for me to be 5% of 20 deals than to be 100% of one deal, right? And so just part of a diversification play and being involved with not only diversification by asset class, but also geography. So that's something that I've done because a bulk of my portfolio now is in Los Angeles and Phoenix, but also I have exposure like in Texas and Atlanta and Florida, North Carolina, and then other things across the Midwest. That helps as well to just be in more than one market. If
I hear you correctly, you then started investing passively in other people's syndications.
Exactly.
Did you ever have your own syndication where you raised money?
So there are, as I've kind of grown and developed, we've had lots of friends and family who say like, "Hey, what are you doing? Can we get involved with that?" So it's just started with, different family members saying, "Hey, I have a chunk of money. It's not doing much for me. Can you produce some returns for me?" And so I started taking on that capital. And then basically after the syndications, then I met a developer partner. So we started developing properties here in LA. So right now we're building 46 single family houses on a couple of different projects. So LA has a huge kind of supply and demand imbalance, right? There's just not a lot of new supply coming on board. And the reality is you can buy a house or an entry level house for very similar to what your rent payment would be. So millennials who want to, they realize they're chunking out $3,500, $4,500 a month in rent, right? Hey, if I could get a house for that, that'd be a better play for me long term. So in that, I partnered with that developer, and I actually have a partner, David Coe, now, and we have a company called Capital Stack Investments. And so we actually help developers to raise capital and acquire capital, so in order to acquire real estate assets.
And is that just in the LA area or all over the country?
We've done some things. I've done some things with a partner in Phoenix. Primarily, the new construction right now is in Los Angeles, just because it's in the backyard and it's easy to keep track of. We're open to other areas, but again, we really like working with proven partners. So usually myself or another investor has gone full cycle with that partner developer. We've vetted them. We've known them for a number of years. We've seen their track record. We've seen how they produce. So I like to do that because it's a huge responsibility to take on someone else's capital or even recommend an investment to someone, especially if they're, your parents or your, brother-in-law, whoever that might be. So it's really important. And what I've learned along the way is like success leaves clues, right? And so you really want to study those people very carefully that have a good long track record, and people that are either starting out or don't have a track record, or you can't really tell they're, what they've done in the past. You're better off passing on those opportunities and going with something that's more tried and true.
Talk about Capital Stack a little bit, because I'm curious how that works. Are you partnering then with developers, and your team at Capital Stack is bringing the equity to deals? Are you also providing like the guarantor on these construction loans? I mean, exactly how does that work?
Yeah, it depends on. I've done all those. So actually, with another partner, just bought 9-unit building down in Long Beach, which sounds small, but it's a $2 million deal in Los Angeles. But like I was what you call a key principal and loan guarantor on that. And then primarily with Capital Stack, we come alongside and we help the developer raise equity, right? And then we become part of the GP. We take charge of investor relationships. So we're constantly keeping investors, hey, here's where the state of the project is. Here's the next hurdles. Here's what the timeline looks like. Here's the challenges. Here's how we're overcoming those challenges. So staying in that, and then also being a real resource for those partners, because between my partner and I, we were able to help our developer with like securing like additional loans, different resources, different consultants. It helps to bring a variety of skills to the table, so that you're not just bringing one thing, but you're bringing, business skills. You're bringing sometimes, deep pockets or extra capital to help solve problems. All those things can be very beneficial to those projects.
I know in the introduction, I think it says that you raised over $7 million from private investors. Talk about the size of the deals you're doing then. You mentioned the 9-unit that was $2 million, which
right.
that seems cheap in LA still.
Right.
But, the size of the deals you're doing, I mean, if you're offering a personal guarantee on some of these, is it for a couple million? What's the biggest deal you've done?
The biggest deal is the 37 single family houses right now. And that's like a 28, but I think now the prices have actually increased a little bit. It'll probably end up being about a $30 million deal for those 37 single family houses. And that's basically, there's 27 on one parcel and 10 on another parcel. And so we're in escrow on 20 of those 37. So just about keeping pushing ahead, getting to the finish line. Fortunately, demand has been really good. The low interest rates have been really good. And that millennial buyer, they really want to buy. It's interesting. California has had a migration of people moving out of state. That tends to be people that are, it's an expensive state to be in. And if you're not killing it, it can be a tough place to live. So I definitely understand why people would want to do that. At the same time, we're also having an influx of like engineers and tech people coming to work in Silicon Valley, or, LA is becoming the second hub of Silicon Valley, right? We have Google here, we have Snapchat here, lots of, SpaceX and Hyperloop, lots of big tech companies are now in LA, and that's bringing in, high income individuals with lots of capital, and they're looking for housing as well.
I'm doing the math in my head. 37 single family houses, and it's a $30 million project. So you're talking about 820,000?
Yeah, between 750 and 950.
Okay, so somewhere in there. So what's the economics on that? I mean, you're putting up all the money are you building one at a time, selling that, rolling the profits into the next one? Exactly how does that work?
Sure. We kind of have 3 phases on that. So we're basically building 11, then building, I guess my math is right, 16, and then building the final 10. So the first 11 are basically at the point where they're sold. People have selected their upgrades, and now those are just being finished out. So as soon as the sidewalks and the sign off, we're going to close those like within a month.
What do those sell for?
The lowest annual started at 750, right? But then with upgrades, or if you get the nice corner unit with more windows and, nicer, these have rooftop decks as well. They look great in photos, brand new construction, right? And they have a tech package. So you can walk in and say like, hey, Alexis, play, relaxing music at the end of the day, or, dim the lights, all that kind of stuff, all those kind of features that are really nice. And so, when somebody comes in and looks at that versus what they could rent for a similar price, or they could go buy a house down the street, but that house was built in 1950s, has no technology. It's like kind of beat up, needs massive repairs. So it becomes kind of a no-brainer for that buyer to buy those.
And what's your margin then on between what you're spending, your costs, and then the profit that you're making?
So we raised $5 million of equity on it, right? And we projected out that investors would make like a 28% annualized return. They're probably going to make a little bit less than that, because we've had a few things like the tariff situation, right? Where all of a sudden, like building materials were a lot more expensive. And then, obviously coronavirus, there was like some concern, and like that caused some delays. And now it's really interesting because everybody's kind of going gangbusters, but because people are backlogged, like for an electrical panel that has to be custom made in the Midwest, it can take 3 or 4 weeks. Well, that's additional time that you're basically burning money, right? You still have the debt service on those buildings. So that's going to creep into it. So we'll end up more in the mid-teens on an annualized basis on that project. Other ones, and some six units on a lot, 3 duplexes. That model has proven to be super great, and I love that model because it's a little simpler to build, and the economics are a lot stronger. Just because the basic economics are on that is kind of buy a beat up house for $500,000-600,000, put $1 million of improvements. So now you're at 1.5-1.6, and then it's worth about 2.6 when you're done, right? So it's just, it's kind of like how do you create $1 million worth of value? That's kind of a real simple play there. And because of house prices in LA, that allows you to do that. Like you could do that same model in a less expensive city, but you couldn't get that premium, right? So that's an advantage of being here in this market.
So your part is bringing the capital stack, the equity and all that. You have your part. It sounds like you're partnering with the developers and the
yes,
people who are doing all the work. How are you communicating with investors then? Like, for example, you have to go back to your investors on those first 11 houses that you built and say, well, your return has gone down from 27 annualized to mid-teens, and here's why. How do you convey that to your investors?
Best thing is just straightforwardness, honesty. I mean, I have I have a philosophy that people can handle the truth and they want to hear the truth, even if they don't like what the truth is. But they'd much prefer that. So you just have to face like, here's the realities. When we started, did anyone expect to be in the middle of a pandemic, right? Or have tariffs, or, these are kind of some unknowns. We've also had some benefits of like actually, selling more upgrades than we initially thought. So there have been some surprise to the upside, and then been some things that will compress returns. So again, it's a matter of like staying in communication. Again, I'm an investor. I'm on the limited partner side as well. So I'm right along on the ride on all these projects. It's part of our business model, is that we won't recommend something else that we're not putting our money into, which I think is always a great catalyst. I actually love the stock market, but I'm very anti-Wall Street. And that's because of all the packaged financial products that get sold, right? And that people end up buying and they don't do super well in them, right? Like, just if you really start to look at a mutual fund and the amount of fees, and after 20 years, how much you're going to lose out by paying a 2% fee, it's astronomical. You can lose at least 40% of your upside. So where you could have ended up with 2 million, you end up with 1.4 or 1.2, right? And it's like, where'd my other 800 grand? Well, it doesn't sound like much, but if you're losing 2% every year, like let's say you made 8 and you end up netting 6 because you paid 2% in the fee, well, then you're only compounding on that 6% gain versus the 8% gain. And it doesn't sound like much. It's like, okay, whatever. But over the course of time, that math and compounding interest is so powerful. It ends up being huge in terms of what you're giving up by paying fees or paying for an overpriced kind of financial product. So you have to be really careful on that. But the point I was trying to make is, like, I would like to be invested alongside a financial advisor, and like, if he's putting his money in Tesla, I'll put my money in Tesla. But for him to say, like, here's this is a great annuity, you should invest in this. It's like, well, how much of your capital's in that deal? Well, actually none, right? It's like, well, like I'd rather say, like, I want to do what you're doing, not what you're recommending that I do.
Yeah, good points there. So is development and raising the capital for development, is that your future now, or do you have other things on the horizon as well?
Kind of seem to always have a few things on the horizon. I like variety. I like being involved. But Capital Stack really started out of people saying like, hey, how can I do what you're doing? I have capital, and maybe they're earning 4 or 6 or 8%, or maybe they're, the market can be great, but it takes a certain, personality and patience and emotional, to see your stock down 20% and not panic. I remember like my Tesla story, like I bought it at 315 or something. Well, 6 months later, it's at 215, right? And so it was like, oh my gosh, like, is this bad? Should I sell? And that, honestly, that thought is there. Like, okay, maybe I should just keep it before it goes to 150, right? And then, now after the split or whatever, it's up like 6x or more, right? So, but it's a matter of being like really disciplined during that time, and not everybody has that kind of discipline to be emotionally detached when you see, what you're counting on, right, as your nest egg to go down. So it's another reason why having a good allocation into real estate is a beautiful thing, because it's less volatile, it's more predictable, cash flows are more predictable, you actually have an asset behind it, right? So like with our development deals, if we ever got to a point where, the lending market tightened and we weren't able to sell those, we could turn and rent those, right? So having multiple exit strategies, but then at the end of the day, having an asset that you control is really a powerful thing.
Yeah, Bryan, if someone wanted to find out more about you or your company, how would they go about doing so?
First place is go to capitalstackinvestments.com. So it's capitalstackinvestments.com. There's a form on the bottom, fill it out. And if you do that, I'll send you a little report on 72 streams of income and how you can build that. And you can see all the different streams that I've done. There's a lot of opportunities to do that. I think just being focused on that and being focused on where else could I generate revenue from, hopefully that will trigger some ideas in your listeners and how they can do it as well, and inspire them to, diversify, find other opportunities, and keep building their portfolio.
So if you have 72 streams of income, revenue streams, why haven't you just called it quits and gone on a permanent vacation?
It's a good question. I considered it actually this last year. We considered going to spend a year in Spain. Like we have one kid starting college now, two kids in school. So they're involved with sports. So they would have to probably give up organized sports and, what could we get plugged in? So that's kept is kind of where we are right now. But I love the game. I like it. I also see there's a lot of value in creating those streams. You can do a lot of powerful things with that cash flow. You can make a big difference in the world. You can contribute. We have a friend who runs an orphanage in the Philippines, and there can be a lot of satisfaction, not just in like, oh, I'm going to buy newer, nicer things and I'm going to, go have a $150 dinner versus a $25, Chipotle burrito. For me, it's more about the company of who you're eating that $25 burrito with than the price of food. So
is that what a burrito costs in LA now?
There you go. Well,
Chipotle, $25.
There you go. You got a family of 5, so I got to do some multiplication. But you can do a lot of good with that, and so part of that is like, okay, what else can we do with this, and how else can we make a difference? And for now, we're stacking the capital stack, right, and continue to build that passive stream, and then we'll explore our future options in the very near future.
The nice thing, it sounds like, is once your kids are through school and off on their own, you'll have all kinds of choices at that point.
Yeah, absolutely. And we probably have more than we're taking advantage of right now, but it's good. It's, part of this is you're building that, some of that stuff happens inside my retirement plans. So some of that's not touchable quite yet. But again, you're building that stream, and I'm actually a big fan of that. I think I have 11 self-directed accounts. So I have self-directed Roth IRAs for myself and my wife. We have a 401k for my business. So like I said, the 401k is the one that you fund for yourself, but you can self-direct a 401k. And if you might actually be able to switch it. If you're working for an employer right now, you might be able to switch to self-directed. Sometimes you can, sometimes you can't, depends on the plan. But if you've switched employers, you can actually sometimes roll that old 401k and self-direct it. And that gives you all kinds of options to invest in real estate with those funds, as opposed to, again, I like the stock market, but what I don't like about the average 401k is usually a person gets very limited choices. They can choose like the Schwab 2040 retirement plan or whatever. And it's like, or they can choose an income fund, but they have very little choices, and they usually can't buy individual stocks in that. That's going to, I guess sometimes they're thinking they're doing that for your own safety and good, but it also limits your choices and options, where if you self-direct now, you can do whatever you want to do with that.
Bryan, I want to thank you for taking the time to just explain how you've created those 71 streams of income. Yeah, and just the arc of your investing experience. You had your father who was looking for that 4% drawdown from his stockpile, versus your mother-in-law who basically had created cash flow for herself that was going to keep self-perpetuating. So, and then just taking it through, investing first in LA in that one single family, the Phoenix properties that you were able to buy during the Great Recession and really take advantage of rushing into the fire, and the construction and development that you're raising money for now. It's all really, it's really fascinating to hear all the different pies you have your fingers in. And I want to thank you for sharing it all with us.
Absolutely, Bryan. Thanks for having me on. And I just want to say to listeners, like, it's possible. People say, like, how did you get the 72 streams? Well, it started with 1, right? And then it went to 2, and then it went to 3. So it's not something you have to think like, oh, I could never get there. I mean, hey, if you can figure out one new one, now you've added to that stream, and it's all possible. So I'd say just get busy. And I think just even being aware and on your radar, you think, oh, hey, wait, that could provide a nice passive stream for me. So just inspiring your listeners to like get out, make it happen. And if we can be any part of that, we'd love to help. My partner, David Coe, and I, we love helping people to figure out better investments. I have a thesis that there's trillions of dollars of poorly allocated money in these retirement or basically investment products that get sold to people, and people end up netting out 2 or 3% or 4% or 5%. And when you can earn in the double digits and you can compound over a course of time, it can be life-changing.
I want to thank everybody for listening to this episode. I'm your host, Bryan Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.